On October 20, 2009, federal agents raided the sleek offices of Galleon Group, seizing a trove of encrypted hard drives that would soon expose a $1 billion insider trading empire. The Galleon Group founder built his empire on stolen stock tips, and the fallout would become one of the most dramatic financial scandals of the 21st century. Raj Rajaratnam, a Sri Lankan-born Harvard graduate, arrived in New York in the early 1990s with a vision of turning his academic brilliance into a hedge fund powerhouse. In 1997, he founded Galleon, a modest investment firm that quickly grew into a multi-billion-dollar juggernaut, thanks to an aggressive strategy of short-term, high-conviction trades. What set Galleon apart wasn't just its speed or its technology. It was the source of its information. Rajaratnam cultivated an extensive network of corporate insiders, executives, board members, and consultants who, in exchange for cash, luxury travel, and the occasional favor, whispered upcoming earnings, mergers, and product launches before the market could react. The web of tips spanned industries from technology to pharmaceuticals. A senior executive at a biotech firm, a former senior manager at a leading chip maker, even an employee of a major defense contractor, each became a conduit for non-public data that flowed straight into Rajaratnam's trading algorithms. By the time the FBI began piecing together the puzzle, Galleon's trades had generated an estimated $275 million in illegal profits and avoided losses of roughly $45 million. The scale was staggering, but the method was disturbingly simple. A phone call, a confidential email, a whispered rumor, and a rapid purchase or sale that capitalized on the market's delayed reaction. The investigation began in earnest when the Securities and Exchange Commission's Office of the Chief Counsel, bolstered by an aggressive FBI cyber surveillance unit, started tracing anomalous trading patterns. A whistleblower from a rival hedge fund tipped off regulators after noticing a pattern of Galleon's trades that consistently preceded major corporate announcements. The agencies, Operation Whistleblower, deployed wiretaps on several of Rajaratnam's known associates, including the infamous tip line that linked the hedge fund's trading desk to a network of insiders. The recorded conversations revealed a chilling mantra: "I'm going to tell you something. You want to make money, right? Just follow my lead." The case exploded in December 2009 when a grand jury indicted Rajaratnam on 14 counts of securities fraud and conspiracy, charging him with orchestrating one of the largest insider trading schemes in U.S. history. The indictment named 12 co-defendants, among them former McKinsey consultant Anil Kumar, former Merrill Lynch banker David Lai, and biotech executive Matt H.D. Marty Arsenault. The prosecution's strategy hinged on the unprecedented use of recorded phone calls, a move that would test the limits of privacy law and set a new precedent for future financial prosecutions. The trial began in May 2011 in the United States District Court for the Southern District of New York, presided over by Judge Richard Sullivan. The courtroom was a theater of high drama, with prosecutors led by U.S. Attorney Preet Bharara and Chief Assistant U.S. Attorney Stephanie R.D. Morris presenting a mountain of evidence: encrypted hard drives, text messages, and, most compellingly, dozens of recorded conversations in which Rajaratnam explicitly solicited and received confidential information. The defense, headed by veteran litigator John H. Jack S. Cohen, argued that the recordings were obtained illegally, that the communications were merely casual conversations, and that any alleged insider information was either public or non-material. One of the most striking moments came when a former Galleon analyst, Matthew G. Matt Marshall, took the stand and described the internal culture. "We lived by the mantra, if you know something, you use it," he testified. If a friend from a tech company said their next product would be a game changer, we didn't wait for the press release. We moved. The jury heard vivid descriptions of secret meetings in hotel rooms, encrypted emails that read "Do not forward," and the swift execution of trades that turned a modest $100 million portfolio into a windfall that funded yachts, private jets, and an opulent lifestyle that seemed almost cartoonish in its excess. After 4 weeks of testimony, the jury deliberated for just 2 days before returning a guilty verdict on all 14 counts. Rajaratnam was sentenced to 11 years in federal prison, the longest term ever imposed for insider trading at that time, and ordered to forfeit $10 million in cash, $53 million in assets, and pay $10 million in restitution. His co-defendants faced varying sentences. Anil Kumar received a 2-year term after pleading guilty. David Lai was sentenced to 3 years, and several others received probation and substantial fines. The case sent shockwaves through Wall Street, prompting an industry-wide reassessment of compliance protocols and the implementation of more rigorous surveillance of employee communications. The aftermath extended far beyond the courtroom. In the wake of the conviction, the SEC introduced new rules that expanded the scope of tipper-tippee liability, making it easier to prosecute individuals who receive insider information, even if they do not act on it directly. Hedge funds scrambled to tighten their internal controls, hiring compliance officers with backgrounds in cybersecurity and establishing clean rooms, where analysts could discuss potential trades without risking contamination from non-public data. Moreover, the Rajaratnam case emboldened prosecutors to pursue a more aggressive stance on white-collar crime, culminating in a cascade of high-profile insider trading convictions in the following years. For Rajaratnam himself, the fall was as swift as it was complete. Subscribe to The Verdict for more stories like this.